What we love about building like from ground up is turning land, raw dirt, and rebuilding the entire neighborhood. The transformation from zero income to when the building is built and leased up, investor can see how they can make money because it goes from zero to millions.
Building from the ground up, end up overpaying. But when you buy dirt at the right price, people may not have the same vision for what that dirt will become, but the ability to transform it. Every step of the way, every transformation, there's like different phases in the development. Every phase that you do some improvement to the land, it increases the value.
Welcome to Designing the Business, the podcast where we go beyond beautiful spaces and dive into what it really takes to build them. I'm Risha Walden, interior designer, founder of Walden Interiors, and your host. Every week, I sit down with brilliant minds behind the scenes, builders, contractors, architects, real estate pros, artisan, fellow creatives to talk business. And we explore how they got started, what keeps them going, and how they've built businesses that not only succeed, but inspire. This week, I'm joined by a sister duo, Nancy and Palmy, the Kitti Sisters. This is a very exciting conversation, really motivational for me. I'm a real estate investor as well as being an interior designer, and what they've done building their real estate portfolio of over $400 million in multifamily assets and how they did that. It's so interesting, and they break it down into the different levels of how they were able to continue their journey and what they needed to do that. Their mission is to help others, entrepreneurs, founders, Americans, stop being the asset and start owning assets. This interview is packed solid with so much information that I could have kept them talking for hours. I'm so glad they shared the time with me, and I know you're going to get great value from it too. So, Nancy and Palmy, why did you start your business?
Palmy, want to take this?
Yeah. So, we started multifamily apartment investing 7 years ago. But before that, we were in the fashion business. When we were in the fashion business, we really didn't understand financial literacy at all. The idea was just make money and spend it. And if you had a little bit extra, that's awesome. Put it in the bank.
Right.
We did that for several years. So we started our fashion business with $2,000, and then we grew that to top line revenue of in the millions. So we were just basically not outspending our earnings. So that's how we had money saved. It wasn't intentional in any specific way. We had a couple single family rentals in Los Angeles. That's where we live. But
Right.
it wasn't based on cash flow. In our minds at that time, we only knew that, hey, you just bank for 30 years in the future and the house going to grow in value, and
Appreciate.
that appreciation is going to be our nest egg 30 years fast forward. But we didn't realize that if we had invested that same dollar outside of the state of California, there's cash flow. That was completely mind-blowing to us. We didn't know that was. Unfortunately, when we were in the fashion business, we were doing really, really well. But unfortunately, almost seemingly overnight, our biggest client shut down all their retail stores. So
Oh.
immediately we went from making great income, predictable income, having orders built out 6 months in advance, to not really knowing where the next dollar is coming in from. And that was a really huge turning point for us. And we had to really figure out fast, because we don't just support ourselves. So we're sisters and but we support our parents, our grandparents, and a few fur babies as well.
So we had to figure it out. And then one thing that came pop up on up top of our mind was we need to do something that can't be outsourced or replaced. And we thought there's no better industry than real estate, doing something about real estate. But here's the thing. Our parents always said real estate is a slow growing business. It's actually in their mind, they're not really thinking it's a business. They just think it's buying rental, and equity happens eventually, like Palm said, maybe in 30 years. But we love business. So we were looking for something that, hey, combine real estate plus business together. And we dabble into single family flipping. It was really great. It was making great income, but yet again, it was too small. It was really hard for us to scale. It was just my sister and I, right? So we were looking for something bigger and better. And then we got introduced to multifamily apartment syndication. And that's when everything changed for us, because now instead of doing it ourselves, we got to go faster, bigger, and scale from zero to over $400 million in a few short years.
You guys are amazing, because what you've done is so amazing. I'm so impressed. But it's stands out to me as a woman is that the mindset that you had at the beginning of all this is the mindset that most women have, like the lack of financial literacy, the misunderstanding over multifamily rentals. I mean, those are things that I've had and had to get over and like figure out. And you guys just went full force. It's so inspiring.
You know,
Sorry, it
like
just makes
that's
me
like
giddy when I hear you guys talk, because it makes me giddy that like recently you posted something, you talked about your field and about how it's very male dominated, right? And you just went beyond that. Can you like beyond that thought? Can you talk a little bit about that?
the first thing is, oh, thank you so much for your kind words. So I think because our backs were against the wall, we really didn't have time to dwell on it too long. Like we hear a lot, it's about like that survival instinct kicked in, and it's like, okay, like do this or you starve. I mean, not that scale, but like, you know, like
Right.
it's kind of like that. Like we didn't have a plan B, and so we had to do this.
Right.
The interesting thing is when we first got started in multifamily, I didn't recognize that it was male dominated, which may sound weird, but it was more like, I don't know, the people that we encountered, I didn't feel that they treated us differently because we were women, because we were Asians. I just felt like at that time, at least the community, the brokers, the property management company, everyone that we dealt with, I felt like there wasn't that barrier. Only
Well,
looking back now, when we're helping other people get into the business, that we recognize some of it is, like you said, it's psychological. It's hard because we were never taught about money. If we were taught about money, I think we would never be in this scenario to begin with, to even have to deal with this. And I recognize now, having spoken to a lot of women who are getting started, some are, restarting their life, having a new chapter. That's a lot. A lot of women who's coming in this space through different scenarios. And
Yeah.
I see that number one is like sometimes they've relinquished that responsibility to their significant other, and so they never had to deal with it. A lot of
Right.
people, maybe previous generation, when they married a little bit younger, it was like get married and someone else took care of the financial responsibilities, and they were the homemaker. Maybe they worked, but they just had someone else take care of that. Even if they were married and their husband was the one who was taking care of them financially, he may not know that much about it as well. And I see the other thing that I recognize having the conversations, that a lot of women feel a little bit intimidated by the room because
Yeah.
these guys are talking big numbers. They like talking in lingos. They're really machos, kind of like braggadocious, like, show me your stuff kind of thing. So I
Right.
understand like that can be intimidating. But if you tear down that facade, there isn't really any difference between what a woman's capable of doing. And I don't have to, preach to the choir there. But
Right.
that's why when we got into this space, I never felt like we were less than. I just felt like we need to figure this out and, go from there.
Yes, we
Yeah.
have full conviction that this multifamily real estate is the vehicle that we should be in and that will create generational wealth for our family. But here's the thing, I don't know of any other industry
I was gonna
besides
say that.
like real estate that actually create this level playing field for, people who are female, people who are of minority, people who have less to, to build something substantial for themselves and their families, right?
Yeah, I was actually gonna say the same thing, because what I recognize also is
Mm.
that unless you're like you're a programmer, you're an engineer, you have some sort of tech background, it's really hard to go from zero to wealth in 2020 going to 26. But real estate is such a analog business, but it's still the one business that you can go from zero to millions really, really fast. It's
And-
the only business right now that can do
And,
that.
and without using all your own money,
Yeah.
without having to do it all yourself, without having to have your own system or your own team, you can actually partner, co-invest with someone, and actually scale pretty fast in a really short period of time.
I think that's the key in multifamily. The difference between multifamily than other businesses, even if you want to open like a laundromat or a UPS store or anything like that, those are
Right.
great businesses. And even single family homes. But the problem is they're all linear. With multifamily, because you have 5 levels of leverage, you have people, time, tools, you have taxes, you have debt. You have and other people's money. So that's a bonus 6. So like you have all these multiples that you can stack on each other. That's
Right.
why you can grow really fast.
So you can just pull on that lever to leverage that particular aspect of the
Yeah.
multifamily. Yeah. I mean, you guys say so many things which are so true. I'm an interior designer, do real estate, not to the extent they do. I wish I'm going to be. I mean, you're so inspiring. Like, what? But I come from that generation where you are in a relationship with your partner, and there was a division of roles. And the hopes with that was that if I'm focused on this and you're focused on that, we can grow twice as fast. Because you can't, as you know, like, it's so much easier when you do it with a partner. It's so much easier when you use other people, or not use them, but work together. So, yeah, I can see, that whole historical thing. And then you breaking it down. Yeah, you guys are
I
so
mean,
smart.
like when you talk about partnership, I think that is for us how we scale from 0 to over 400 million assets in 7 years. None of that's possible without having the right partners. And
Yes.
in this business, because there's very clear delineation of roles and responsibilities, it's really
Right.
easy to have successful partnerships. Outside of your family, you have basically 5 different type of responsibility in multifamily syndications. So you have someone who finds the deal. You
Yep.
have someone who's like really good at like underwriting the deal,
Mhm.
doing the math, loves screens, don't want to talk to people. You
Right.
have someone who have relationships with the broker, the property manager. You have someone who helps raise the capital. Now,
Mhm.
everyone raises capital, but there's someone who's really good at it, right? On the
Right.
team. You have someone who has the asset management skills. What
Yeah.
we talk about, you have 2 wins when you buy multifamily. You win the deal and you win the deal. So you win the deal by purchasing the deal because you're competing with other people, but you really win the deal when you
Deliver.
successfully sell the deal. You successfully
Deliver for
deliver
your
for your investors
investors.
and you sell the property, right?
Right.
The
Right.
5th position is the person who has a balance sheet. So what you lack, what we learn is what you lack in ability, you make up in leverage. So these
Right.
5 buckets, what do you have? Which one can you fill? And for
Right.
us at the beginning, when we were trying to be lone wolves, we thought we need to go. We live in Los Angeles, but we wanted to buy in Texas. And we thought
Right.
we need to go to Texas. We need to go underwrite these deals.
We need to move to Dallas.
Yeah, all this stuff was in our mind. And guess what? We didn't win any deals. We spent so much time and effort underwriting deals and we won none. Brokers weren't taking us seriously because we had no track record. It's really a
Right.
chicken or the egg business. Unfortunately, it's an unfair business. If they know you, you'll win the deal.
Right.
So therefore, we as newbies, we thought lone wolf, we're going to go and do this, and it didn't work. But the minute we flipped and we were like, wait a minute, why don't we find a partner who have those relationships and we fill in the gap? That was really when everything exploded.
Yes. And then like now we become those partner who people want to partner with because not only we have the know-how, but we have the track record, we have the relationship with the brokers. We
Yeah.
have our team to do the asset management. We are great at raising capital. And then we
Right.
have the balance sheet. So now it's more of like people coming to us and we have to learn how to say no to good and absolutely just yes to great.
I love that. And within your partnership as sisters, do you break down, okay, you do this because you're better at this and I do that. And how do you do that?
I think it was
was
really
natural.
organic,
Yeah.
right? Like whomever like to do what. And at the beginning, we didn't have a like defined role. It was like we kind of all did it together. But then what I realized was like when Palm was like learning how to do underwriting, I was like, I'm not really into it. So she always tell me is that you don't like to do something, therefore I have to do that.
But like, I think it's more like at the very beginning, it wasn't, honestly, there wasn't that much to do. So as you build up, you have an actual portfolio, you have investors, then naturally, for instance, she's deals more with like the front facing, right? That's why you met her. You didn't meet me. We were at
Right.
the
Yeah.
same,
Okay.
we were on, we were same places,
Right.
but you didn't see me. But like, so she's more like, hey, connection, networking with people, stuff like that. But like when it comes to the back end of investor relations and dealing with the asset itself, it's something that I do really well. So that happens kind of naturally. It's basically like what we're fortunate that we don't have overlapping skills. So what she doesn't like doing, I can do, or I have to do. So so that's how it works. But we do have a team, so the team fills in even more gaps.
Sure. Yeah. I love that. So what impact do you want to leave? You talked about generational wealth for you and your family. I know you have a broader impact than that.
Several. So in terms of multifamily, the cool thing that we've seen is there's a lot of families who get involved in real estate. that's the cool thing that we've seen. There's other sister teams or other brothers team, father, son, mother, son, father, daughter. And the common theme is parents who have businesses, sometimes the skill set to run that business isn't transferable. For example, if dad's an engineer, there's some skill set that the daughter, the son may not have or may not want to be in that business, but they want to sustain a lasting legacy beyond themselves. So what they do is, and they get into real estate, they get into multifamily syndications because they want to pass that on, because that's passable, that's transferable. So one of the thing that we're really proud of is that we're able to be even a small part in their generational wealth. Beyond just doing it passively, we have families, for instance, like the most recent example is we partner with a father and son team who are complete brand new to multifamily. The father was enthusiastic and supportive, and the son just had the willingness and desire to actually do the work. Because when we got started, someone had to help us along. We just felt that, hey, we're going to be a part in that. So it was really fulfilling to be able to help someone come along when this is what they want to do. So the right partnership opportunities are really something that we feel grateful that we're able to now, pay it forward to someone else. Beyond multifamily, beyond this, we also are very passionate about animal rights. And part of our goal is also to start a foundation that two parts. One, we already do this personally. We help fund some hospital bills at an animal hospital that we go to all the time. So that's something that we've done for a long time, and we want to grow that, where we have a fund that can help support lower income animal parents when they need to go to the vet. And we want to partner with the right vets because we want them to be locally owned, not multinational corporations. Vets with a soul. That's kind of how I feel. The other part is we want to do our foundation to also fund research into some critical animal illnesses that has impact our lives specifically. And so that's kind of the driving force. So like as we build more wealth, it's not for us to just spend more on Lambos or something like that, but it's more about what impact can we do. And we know the people that we invest with and the people who are our partners, they also have their own passion projects. So by us doing well, we don't just help the causes that's near and dear to our hearts, but we also allow them to also participate in theirs as well.
That's a big vision. You guys think big. I love it. I love it. What's your favorite acquisition story?
Okay, so this one is cool.
So as you guys may know that multifamily is a team sport. So in order to win deals, it's not just like a lone wolf where you just make a submission. And before we make a acquisition in a deal in Houston, it was $68 million. Palmy happened to text like...
So background is we've invested passively in Houston, and we like to, if we can, invest passively in a market that we don't know first, just to have a feel for how it goes. And Houston's a really hot market. So Houston, if people are listening that aren't in Texas, Houston used to be just an energy hub. Refinery, they do drilling in the Gulf of, I think it's now called Gulf of America, Gulf of Mexico, now America. So they used to do drilling there, right? So Houston used to be very dependent on oil and gas. And so if that sector drops, then the economy kind of falters. But Houston has grown to be way more robust. There's Fortune 500 companies, there's tech businesses, still energy, there's manufacturing, and it's a port, right? That transportation port for the US as well. Population growth really strong. So we got wind that there's a property that's being listed. The price was $71 million. We ended up purchasing it for $68, but it was $71.
But the interesting part about
we didn't have connection. Any connection to Houston. No one knew who we were. We've purchased in Dallas. We've purchased in Phoenix. We've purchased in Atlanta, but no one knew us in Houston. Time. So I recognize that my friend has purchased like a lot of properties from Houston. I know that he would know this broker. So I texted him and I said, hey, do you know this broker? And he said, yeah, he's a good friend. What's up? So my next question was like, are you buying this deal? Because he's such a big player that if he was buying it, we would have no chance. So I would just not even try.
And to our surprise, he said no, but he will give the Kitti Sisters the street cred. And that's when that was a cool story for us, because it's about, networking, it's about building that relationship. Who knows who, right?
So it's not about who you know, because I know a lot of people and they don't know me. So most important is who knows you. And so this person, he's a big time multifamily investor, and he gave the credibility to us because we had to raise $34 million for that deal. Up to that point, I think the most we've ever raised was what, like 16 million, something like that?
13 million.
13
and
million.
that was just like 4 or 5 months
prior to
this deal.
Yeah. So we've never raised anywhere near that. And
for him to have that confidence in us, for him to have that conviction that we could do it, that was everything.
Yeah. And
we didn't fail him. We did not fail him.
What happens is, and we've experienced this on the seller side as well. So what happens is that seller wants execution certainty. And we lean a lot on the broker's opinion of who we should select as the final buyer. Because when we're tied down to these properties, it can be 2 to 3 months and economic conditions can change. We just want to make sure that this person is going to be easy to work with, has the wherewithal to raise the fund, get the loan, and actually close the deal. And a lot of times we go through interview stages with them. They'll ask us questions to make sure that we're legitimate and that we know what we're doing. But because our friend put in that street cred, it added that level of certainty. So it was never a question of, hey, Palmy and Nan are new to Houston. Are we going to be able to do this? It was always, we were always competing on the same level playing field as any other buyer. So it was never like, oh, because if we have even a slight doubt in the buyer's ability to close, they're going to be off the list. No offense, but like we need this deal done, right? That deal coincidentally was purchased right as interest rates were starting to rise. And market conditions were so tough right then. We had the lender started, instead of lending billions of dollars, they started collapsing down on what they'll lend. And they actually chose between us and a family office that was buying in Nashville. The reason that the lender even would continue with our loan because we have a relationship with them. We have many loans with them. So the loan structure was tricky. The interest rates was climbing. We were raising a lot of money. The lender, I think like the week before closing, told us, hey, your loan proceeds, it's going to be slightly lower. And if other people in other scenarios, they probably can't close because they've already maxed out what they can raise. Luckily for us, we've already pre-raised a slightly extra anticipating this. So that wasn't an issue for us. The lender made us go back and ask for a discount just because the market conditions, we've never retraded. That's what it's called. Retrading is what is the term for asking for a discount, but we've never done that. We felt really uncomfortable with the lenders. Like, you're going to have to go and ask for a $10 million discount. And we're like, I don't think they're going to sell to us at that discount. But we went back and we explained the scenario. Hey, leverage is lower, interest rates climbing. We need a number. And through some, I think, like tough but fair negotiation, we settled at 68 million. And that's what we close at. So it's a unique time frame. Historically, it's a time frame that we all remember how hard it was to get the loan finished, not because of the raise, but just because of the market macroeconomic. So the story behind it, I think, makes it memorable.
That's a great story. I love that. And so now you have to. I mean, you were told you got to do this, and you're like, okay, we just got to go do it because we're not gonna. Because everything then, like the street cred and the people, this network that you relied on, now it's all gonna come back in your face, and that's
and it's a business. Unfortunately, it's like you're one and done. There's no second chances. So it's a small world. If you do something and fail, they will know. And so that's why we talk about, hey, you need partners. You can't try to do this yourself because if you try to do it yourself and you fail, that's your one shot. You don't have a second chance. So you have to really understand that.
Yeah. So on that, is that the biggest mistake you see people who are entering the business doing? I
think the biggest mistake that we see people do is just trying to go in on their own and trying to buy
start smaller,
like 10 units or like 30 units. It's not really scalable. And why do we say that? Because you can't really hire a professional like property management team to run the operation on a day-to-day basis. Like
unless you have like 65 units and up, the economics doesn't work. Like Nan said, it's all about the entry point into real estate. I think we all understand that real estate purchase at the right price in the right market is always a no-brainer, right? It's a really low-risk investment with the right loan product as well. The issue that we see, and we were equally guilty of this, is thinking we have to start small and thinking we have to do it because we have to do it ourselves.
And using our own money only.
Yeah. And so it's overwhelming for people to get into the space and think $68 million. And I wouldn't recommend anyone new to do that either. But our first property was a 6.9 million property. Today it sounds really ridiculously small. It was 76 units. Even back then, that was even that was considered small from the time we purchased. So I would say, don't think, especially if you have aspiration to scale, and I think we all should, when you go small, you're going to have very incremental improvements. Anyone, if you study rich, successful, wealthy people in this country or the world, their growth is exponential. So what I say is your income growth there, like your payroll, they bump your income. That's linear. They may give you a 3%, 5% bump yearly, right? That's a linear growth. But if you want to grow your wealth massively in a short, compressed time, you need exponential. And you can only do exponential is when you go big.
Yeah. Very, very true. Absolutely. When you have a new person starting in there and you're saying, don't go as big as you can get. What's your sweet spot for you to be? What kind of acquisitions are you looking at?
So our buy box is actually like 200 units, 40, 50, $60 million or above. And we only go after Class A and or newer build because from our experience, buying older assets is really hard to deliver for our investors in today's environment. On top of that, we love to buy in emerging markets that we see have a long-term opportunity growth.
Yeah. So right now, and that's why I say when we say, hey, our purchase price is really high, if someone new comes in by themselves, they may feel intimidated. But because when you partner with people who have that experience, they'll take care of a lot of the things that you're nervous and you don't know how. So our buy box is higher. We're doing new development. We're doing build to rent projects, build to sell projects alongside of purchasing existing buildings. Right now, the market, even if you want to get a loan, it's hard to get C-class loans, let alone managing it. To buy it, it's hard.
C-class is anything 1970s built.
Yeah. So it's kind of like your grade right now. You think 70s is C, 80s is B, and A. So it's like basically like mid 2000s to like 80s is like B, and then anything mid 2000 and newer are A. So it's sort of like kind of like that. But buying the newer things right now is what is easier to get loans for, easier to manage. Yeah.
And you guys are going, though right now you're going beyond just acquiring built. You are doing like this massive project. Yes. You want to talk about that because that's exciting.
Yeah. So what we love about building like from ground up is turning like land, like raw dirt, and rebuilding the entire neighborhood. And the transformation of it, like people could imagine like from zero income to like when the building is built and leased up, it like significantly investor can see how they can make money because it goes from zero to like millions.
I think like the competitive advantage of building from the ground up is that if we're able to buy the land at the right price, we are going to be at the lowest basis possible, because if you're competing with a whole bunch of buyers for a Class A apartment, you may end up overpaying. But when you buy dirt at the right price, people may not have the same vision for what that dirt will become, but the ability to transform it every step of the way, every transformation. So there's like different phases in the development. Every phase that you do some improvement to the land, it increases the value. So for instance, raw dirt, not entitled, mean that it's not approved to be built for a certain thing. It's one price. The minute it becomes entitled, for instance, ours was entitled to be townhomes or multifamily or retail, whatever it is, that increases the property's value because it took time and effort for us to get the paperwork through the city to get that approved. Once the entitlement's done, it's still raw dirt. We haven't built anything, right? So that already increased in value. But the moment that we have plans approved by the city, shovel ready, it increases the value again. Yet we have not actually started building anything. We didn't touch the dirt yet, right? 3 first steps already increasing the value. Then we start horizontal development, which includes laying all the pipes underground, putting in the streets, all the foundations that's necessary for things to be built on top. Once horizontal is done, again, really big increase in value. It appreciates significantly. When the buildings are built, vertical construction's done, ready to be moved in, that increases the value. But the awesome part is once it's income producing, the value jumps even higher. And so every step we can have multiple exits. We could have exited this project at any point in time. We could have sold it when it was entitled. We could have sold it when it was permits were approved for us to start construction, horizontal completion, vertical completion without leasing. And because we chose to do these individually deeded units, we can actually sell them one off as well. So we're building 118 units right now. That's built to rent, townhomes. That's built to rent. It's a long-term community project. We want to hold it so that we can have the infinite cash flow strategy. So basically, once we finish the construction, we lease up the units. We will take this property and refinance it into permanent debt. There will be cash that we can extract because, again, the laying effect, we've been adding value to this property every step. Now we're extracting some of that value. But the beautiful part about income producing assets is that we don't pay the mortgage for that cash out refi. The residents do, and they happily do, because this is a new construction. This is like their home. It's like a home. It's their home without a mortgage.
Right.
So we do that once. In a couple of years, market appreciates, income increases. Guess what? We get to do that again.
Yeah.
And that's all cash that is not taxable. It's tax-free cash that our investor keeps getting benefit from. Today, I was on a call with potential lender on a different project, and she wanted to talk about, hey, I want to be part of your exclusive mortgage team for the build-to-rent community. And we're like, oh, no, you can't, because we're not selling them. The goal isn't to sell. The goal is to keep it for a long period of time. So yeah, it's pretty amazing. So that's the project that we're working on. The other project we're working on is a build to sell. So that one's slightly different. That one is a short-term, hey, build home, sell it, get cash, use that same dollar, rebuild the second phase, third phase, fourth phase. So that's 105 units, single family home.
So this question is like, why did you make the leap from acquiring existing to building yourself? Like
I said, the issue is market conditions. Buying existing apartments, pricing right now, I think like there's still a disconnect. Yeah, interest rates has risen a lot, but sellers still wants to sell it for a premium that we feel like is not optimal. And so we decided if we build it ourselves, we can start at this basis down here and benefit from that, from the delta between what we can sell it for and what it costs us to build.
So for us, we're not married to one particular asset class. We do have our favorite. For us, our job is to deliver for our investors. So when we see the opportunities of building something from ground up and that we can potentially give a better return for our investors, we just dive head in.
Yeah, and I think like it's about like diversification within real estate. I think it's a good idea to have different type of scenarios. This one is a longer play because at the beginning, the first 2 years, there's no cash flow because we're constructing, but there's a higher upside. While our existing though, there's cash flow, but the upside is there, but there's a cap. This one, we know we can keep it long term because we know the builder, which is us. So the playing different games and any smart investment firm, I don't think we should be a one trick pony. We should be agile to the market. If it's the optimal time to acquire existing properties, we'll do that. If like we have multiple investment vehicles, even within our firm, we have the existing business multifamily that we're purchasing, a whole bunch of those. We have our build to rent community. We have our build to sell. We even have private credit. So we have a variety of different buckets because not every investor wants the same thing. And it's like Nan said, it's our goal to be available for them to whatever they need. Some people want cash flow. Some people want appreciation. Some people want a longer term hold. Someone wants something shorter. So I feel like we were just addressing we listen to what our investors' needs are, and we try to find the right type of real estate asset that matches what will be best for their investment.
And you're not afraid to jump in. You're like, okay, let's do this and add the next phase, the next diversification into your portfolio.
Yeah, the key here for anyone who's listening is I would be afraid if we're doing everything by ourselves, and we're not. We're not doing any of these things by ourselves. First is like a lot of due diligence on our partners. So even partners that we join or when we were getting started, we had to do due diligence on them. People knew who's coming in to do partnerships with us going forward, we also do due diligence on them because, like we said, none of this is possible if we didn't have the right people who already know a lot of the things that we don't know. We don't pretend to know everything about this business. We just seek out the best partnership possible. And that's a cool thing. Like every step of the way, I feel like the level of partnership has just increased. The size, the scope, the experience.
Yeah.
And even this year, within the past few months, the connections we've made, I was just joking to Nan about Kevin Bacon's 6 degrees of separation. It's real because we manifested, we wanted to meet someone, and now we're like one step away from that person through a connection that was like almost off the cuff. And so it's like,
I think like getting access to like the right deals, having the it's the seat at the table on the right table is important, and that's a skill set that everyone should learn versus like trying to do everything themselves, trying to find their own deals, manage
yeah,
like small
that's why
properties.
you can't scale. If you study all the biggest firms in the world, none of them were able to do it by being a lone wolf. They were able to do it because they sought out the best people possible to partner with.
You guys are great. It's just inspiring, breaking down so many ideas that are kind of ingrained in what, how you should do business or how you should work, like do it yourself if you want it done right. And it's like, none of that is true. And you're proving it. I love it. I don't want to take any more time, but you guys, thank you so much for spending this time. I'm so loving what you guys are doing and sharing. So if anybody wants to get a hold of you, where's the best place to do that?
So if you want to go faster, scale smarter, and do bigger deals, go to jumpstartapartments.com, and that is jumpstartapartments.com.
Okay, great. We'll put the link below. But thank you so much, Palmy and Nancy. I really have enjoyed you guys. It's so exciting for me to hear what you're doing and how you're thinking. I love big thinking.
Yeah, I go big now. And, I hope that everyone feel inspired that it doesn't, if two girls from California who have really no business to be in this space at all can do it, anyone can do this. It's right partnership. I think that's the most important part.
Yeah. Well, it's nice seeing you guys, the sisters, doing it. Thank you so much.
Thank you. Thanks for having us.